Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Good morning and welcome everybody to the March webinar, where we titled it Prepared for the Storm, but perhaps when we sent out the invites, we weren't exactly prepared for what has been a really significant change in the geopolitical and macroeconomic environment over the course of recent weeks. So I'm going to present over the next 10-15 minutes a quick update on some of my thinking with regard to the macroeconomic environment in the wake of Russia's invasion of Ukraine. And then I'll hand over to Piers and he'll walk you through how the technical analysis environment has changed because of market moves. So let's move swiftly into the presentations and with my content slide. So I'm going to look first and foremost at a question that, no, I'm not mad. I'm going to ask the question whether we're heading towards the next recession, and then what that means for how monetary policy thinking, which currently suggests significant interest rate increases, might be altering over the course of the months to come. Before looking at the inflation environment and how that's changing and moving on to FX markets and how the FX market risks may well be altering as well. So let's dig straight into the detail of the presentation with the next slide. And so, as I say, I'm not mad with regard to why I think that we may be heading towards a new recession. Because what we've seen in terms of oil prices and commodity prices, and particularly the oil price recently, has been such a sizable dislocation in the market that I think the effects are going to be more widely felt than is currently anticipated by authorities. So this big rise in energy prices, which actually is dwarfed by what we've seen in gas prices, natural gas prices more than doubling, I think could cause a significant correction in household disposable incomes, not just in the UK, but in the Western developed world. And consequently, I think that will arrest a lot of the momentum that we've seen behind the post-COVID recovery. Not only that, inflation now looks as if it's going to peak higher and actually take longer to then come back down. And I don't think that we're going to get an equal move higher in wage inflation in any of these countries. So consequently, it's that erosion of disposable income and therefore the effect that will have, particularly on discretionary purchases, that could be very damaging as far as economic activity is concerned in the West. More importantly as well, I think that the West is going to have to spend a considerable amount of additional capital, probably driven by the fiscal authorities, in order to gain greater energy independence because of what we've seen with regard to Russia's invasion of Ukraine. And then another additional as well, I think there is an increasing risk that we're going to see the fallout of this in terms of a potential Russian default. And some of its neighbors that have been supportive of Russia's actions could be facing similar penalties, particularly with regard to sanctions, which are also being levied against Belarus alongside Russia. So there is, I think, an intensifying risk that not only do we get an economic slowdown, but we could actually see Western economies falling into recession over the coming quarters and years. So move on to the next slide. This is what the markets have priced in at the moment for the UK and the US. So in the UK, you can see there 5/6 interest rate hikes from the current position, albeit that I think we have seen some sizable corrective action in markets, so that previously they were thinking that actually rates, by the time we reach the February meeting of 2022, the rates could be above 2%. We're now looking at it being around about 2%. I still think the markets are pricing in too much for UK interest rate hikes. And I thought it was very telling what we saw from the Treasury Select Committee when they were grilling Bank of England members that a number of Bank of England members were somewhat uncomfortable about the number and frequency of rate rises that were being priced for by the financial markets. And I think there's also a recognition that this is supply side led inflation. And consequently, there's actually relatively little in the short or medium term that central banks can do about it. All they're trying to do is cover the prospects of this leaking into a more widespread second round effect on inflation. And I think they've already done that job to an extent by raising interest rates up to 0.5%. And in all reality and likelihood, we'll see UK interest rates rising to 0.75% when the Bank of England meet next week. For the Federal Reserve, there's probably a stronger case to argue for higher rates in the short term, although I do believe that they're probably not pressing the panic button yet with regard to the number and frequency of rate rises that need to be put in place. And certainly they don't need to go more quickly in terms of the scale of rate increases. So it looks as if next week's Federal Reserve meeting will see them sanction a 25 basis point rate rise, with further 25 basis point rate rises to come over the spring and summer. But again, I think that the terminal rate may well turn out to be a lot lower than the markets are currently pricing for. And that because the effects of inflation on household disposable incomes and the potential for a slowdown or even a reversal in private sector investment intentions will mean that the economic outlook looks materially worse than it did at the beginning of this year or even towards the back end of 2021. So if we move on to the next slide, and this is effectively correlating what we've seen with regard to oil price rises and then recessions. So we saw in the early 1990s that both the UK and US economies going into recession for different reasons, but that was associated with a 50% increase in oil prices. Again, if we look to the late 1990s, early 2000s, there were other drivers behind the recession, but there was also an associated 50% increase in oil prices. The global financial crisis, we saw more than a 50% increase in oil prices just prior to the financial crisis really hitting home. And then thus far, we've seen more than a 50% increase in oil prices over the course of the last few months. Now, not every recession that we've seen has had a 50% increase in oil prices preceding it, but every time you've had a 50% increase in oil prices, you have had a recession. So consequently, I would be materially concerned by what we're seeing with regard to oil prices at the moment, and the fact that central banks seem to be very sanguine over the rise in energy prices generally, suggesting that energy prices being this elevated won't cause a larger, more widespread problem for the global economy. I think it will. I think there are a number of economies that are very highly leveraged at the moment. And the last thing that they need to add to the problems of high energy prices is higher interest rates as well. So be interesting to see what happens from here. But I think central banks are getting this particular position wrong in terms of that they should be paying a lot more attention to this big surge in energy prices that we're seeing at the moment, because it could cause some significant economic pain with regard to both consumers and businesses. So moving on to the next slide. And what we saw over 2021 is not likely to be repeated in 2022. So we saw average earnings growth generally moving higher than we saw inflation, although inflation was playing catch up towards the back end of 2021. And now in early 2022, we've seen inflation rates continuing to surge higher, but average earnings growth has backed off. So average earnings growth now is definitely calming down and probably settling in somewhere between a 3.5% and a 5.5% range for annual average earnings growth, whereas it is expected that inflation rates in the UK and in the US will top 8 to 8.5% over the course of the next few months. As far as retail price inflation is concerned for the UK, wouldn't surprise me at all if it rose to beyond 10%, given the influences that we're seeing on short-term pricing. And I do think that it will take longer for the inflation rates to fall back to target. So probably a much longer period, almost the entirety of the forecast horizon or the projection horizon for both the UK and the US. But the fact that inflation outweighs wage growth should be of significant concern to monetary authorities, the effects of which are going to be a sizable reduction in economic activity, in my view. And consumer prices are rising, but they're not rising as quickly as producer input prices. And that's another reason to be concerned about the outlook for businesses, because they're not actually able to recoup all of the price increases that they're facing either. So I think inflation outweighing wage growth is of concern to the authorities, but what ought to be of greater concern is that reduction in household disposable income that I've spoken about a number of times already. So moving on to the next slide, and my final slide, talking about the foreign exchange markets. Now, I recognise that these forecasts look wildly out of date, and we've already talked about the fact amongst those that produce the forecasts about the fact that we are going to have a serious think about what the geopolitical instability means for sterling against the euro, against the dollar, a euro against the dollar, and a lot of other main currency forecasts. So I wouldn't pay too much attention to the current forecast outlook because it will be revised over the coming weeks. What I would stress is that there are significant downside risks in the short term to both the pound and the euro against the US dollar because of the geopolitical instability between Russia and Ukraine. And the fact that sanctions may well ratchet up further is another reason to be concerned about general financial market stability. I think it will reduce liquidity and increase volatility. The other thing to add into this is that we're clearly seeing the Russian ruble coming in for a lot of pressure. And the main beneficiary of all of this is not the seemingly the US dollar or other safe haven currencies, but actually the main beneficiary appears to be the Chinese renminbi, because they're going to get greater energy stability in terms of they're going to be importing more energy from Russia. Unchallenged as well, given the fact that there's not really a market for it in Europe currently. Equally as well, it's probably going to deepen ties between the two nations as Russia becomes more dependent on China in order to sell a lot more of its product. So just watch out for that. But the ruble, I think, is going to come under additional pressure. Wouldn't surprise me at all if we see a further 30-40% depreciation from current levels, or even more than that. Quite frankly, because the Russian economy is getting very, very close to defaulting on its debt, even with all of the foreign exchange reserves that it allegedly has. But I would stress that quite a lot of those foreign exchange reserves are tied up in the Federal Reserve or with the European Central Bank, and the sanctions placed on the Bank of Russia, the Central Bank of Russia, mean that those reserves are non-accessible. So that's why we don't have any forecast for dollar ruble at the moment, because quite frankly, the situation is changing on a daily basis, and we want things to calm down before we can make any logical conclusions with regard to where dollar ruble may be heading. But this also could cause greater instability in emerging markets as well, so of some benefit in terms of exports that would otherwise be being made by Russia. But equally as well, the higher inflation environment, I think, creates additional problems for emerging markets that may be tackled with higher interest rates. But of course, that means the potential for lower growth. So that's it. That's my presentation done. We'll take Q&A at the end of Piers' presentation. But without further ado, and just after my disclaimer, I'll hand you over to resident technical expert, Piers Leslie, to discuss what the changes mean from a technical perspective. Piers, over to you.
Hi, thanks, Neil. Let me just adjust the camera. Look, I'm too tall. Right then, fascinating stuff as ever, Parky. Really good to hear. So I'll just crack on with the charts. So if we go to chart number 1, this is the dollar index. I always like to start with the dollar index because that's the main traded currency and it sort of gives us a clue what's going on. And in here, we're just looking at the monthly chart since the year 2000. We take the collapse from 2000 down to the financial crisis, and the rally's back up since then. And the two levels I talk about a lot are the 61.8 and the 38.2% retracement. And if you look on that chart, you'll see that price has just bounced between those two levels for the last sort of 5-6 years. Now, we're heading up towards the 61.8%. So as you start to head up there, you should start to see some resistance come in. So that's one thing just to keep an eye on. As we approach that area, should be some resistance. And if we move to the next slide, I've zoomed in to the last couple of years. And if we just put the retracements the other way on the last pullback back down, we can see that prices approaching that 76.4%. So this 99, that's 99.70 area, and the 61.8 on the other side is 101. So that 99.101 area should see some sort of market slowdown. We've had a massive move up since the sad situation in Ukraine sort of taken hold in dollar strength, but maybe it's just going to start to abate a bit here, just as it sort of pauses at those levels. I think one thing we could really just keep an eye on, just to see where everything is while we're above the, if we get above 98, 30, 35, then I think we go right up to that 101. So watch out if you get a monthly close above there. That means that the market's even more concerned, bought into the dollar more, and that will target that 101 area. So where does it start to abate? Where do we start to sort of see the demand for dollars actually falling and potentially coming back down? If the dollar index gets back below 95.65, and that's that pink line going across the chart, if it gets across there and goes below it on the monthly close, then the demand, something's changed in the whole situation. So that's a bit of a relief. But at the moment, pressure is on the upside. And if we go to the next slide, we're going to look at euro dollar. So on the euro dollar chart here, we can see that prices for the last few months, price was held by that 61.8%, which comes in about the 111.90, 111.87 area. But then this month, with the massive move into the dollar, we've seen price collapse right down to the 76.4% at 108.60 level. So that's an area to keep an eye on. It's rallying off it just at the moment. Will it continue to do that rally off it? Because any break below that 108 is going to be a very negative time indeed for euro dollar. So if you get below 108.60 on a monthly close, it starts to open up sort of the 104 area. And we just need to watch how that goes. One thing that isn't good is that the Ichimoku cloud, the big yellow blob on the cloud that you can see, there's something called the lagging line, which is that pink line. That is now clearly below the cloud, and also prices. So that sort of suggests on rallies will get sold. It's a sort of historical lagging moving average. And while we have that, I have a fear that we could see the dollar strength continue. So really, to get back positive on the euro dollar, we need to see it back above 112. And if we see it below 107, let's say 107.68, then I think we've probably got a move lower going to happen. So the 107.68, the 108.60, there's a 1 cent support band there. Below 107.68, monthly close, 104 opens up. If it gets back above 112, the risk's off, and we might see the dollar start to weaken a bit and the euro capture some strength back. So it's really a case of watching that sort of 4 or 5 cent range, just as the market tries to work out where do we go after this terrible situation. Right, so if we go to the next chart, we're going to look at the sterling index. So the sterling index is something we've looked at for a long time, and we keep looking at this 38.2% retracement line of the whole move down from 2015-16 to the 2016-2017 time. So that collapse in sterling, when we've seen sterling's value come back on an index-based basket, every time it gets that 38.2, it struggles and comes back off. Now, the worry is that a couple of months ago, January, it was above that 38.2%. It all looked good. But as the events have unfolded over the last couple of months, it really has hit sterling badly, and sterling is back below that 38.2%. So it couldn't capitalize on those gains. My sort of concern here is that you start to break that dashed trend line. That's the support line, the line going underneath the current price action up. If you start to get consistently lower closes monthly below that, then it sort of puts the pressure back on sterling. People are worried on sterling. So I think the real key here is going to be look at the quarterly chart. And the quarterly chart we're going to cover next month, because that's always very interesting on the sterling index. We haven't had a quarterly close above that 38.2% since the 2015 collapse. So that's what I'm going to look at. Where does sterling close this month? Because that will be where sterling closes the quarter, and it will give you a good view on where people are sort of putting sterling in their position. So how does that index reflect through actually onto the currencies? If we move to the next slide, we can look at sterling dollar. So I think this sterling dollar chart is very nice, very simple. I put a couple of things on. I know some of the clients, you look at the Bollinger Bands and they're very useful. So the Bollinger Bands are the two red lines which sort of wide go round the price action, but they're sort of controlled by this 20 period simple moving average. And then you take two standard deviations, and that's how you get those red bands. But the thing is, you're now below the 20 period simple moving average. You're clearly below it. So that sort of suggests as price rallies there towards that sort of 135.70 area, 136. Remember how important the 136.30, 60 area was on our call the other month, or on the daily and weekly charts I've been putting out recently. So that is going to be the key resistance, because the danger here is that this all started, this move lower, don't forget, with a bearish outside month that happened last June, July. It was the reversal of the uptrend. And since then, all that sterling dollar has been in is decline. It went to the first retracement, 23.6%, and it held that 135.70 for a couple of months. Then once it broke below it, it's used that as resistance. Now, the last time it got down to that key 38.2, we saw it bounce. And that 38.2 is at 131.57. So it bounced off there at the end of last year, really impulsive. And that's what you want. You want an impulsive reaction. You know, you meet someone new, you go and talk to them, you think you're getting on, you want that impulsive reaction back. You don't have to persuade them that you're a good person to sort of like go for a drink with. But you want that impulsive reaction. Now, this time, we've come down to that 38.2 and there was no impulsive reaction. The dollar strength was just so strong, it's cutting through it. But there's a long way to go to the end of the month. And the key will be, where does it end up with that 131.57? Because if you get a clear close below 131.57, it sort of targets the bottom of those Bollinger Bands, which is around the 58% area. So that could take you down sort of towards 128.5, 128.25. But really, the bigger picture, if it goes below that 38.2, could be the 61.8% down in the 124s. So it's going to be a real key month this month to see how it closes. And that's going to affect the quarterly chart as well. So we really need to look at the quarterly chart. One just additional thing that isn't very good for sterling dollar here is the RSI at the bottom of the page. That is confirming the move lower at this stage. You know, before when it went down, it didn't confirm. As it got to the 38.2, it did a bit of a bounce back up, and that was good. But here it's still confirming the move lower. So there's nothing at the moment to say buy sterling dollar unless we get that hold above 131.57, the 38.2, a nice spike on it into the close of this month. That might produce some buying interest. But at the moment, 135.70 resistance, 131.57 is the pivot, and below that, 128.25, 128.5 is the risk underneath that if it closes below that. I think I've said that far too many times because it's gone around in my head too much. So let's go to the next slide and not talk any more about sterling dollar. Right, here is Euro Sterling. Now, Euro Sterling I find very difficult because I know 50% of the people watching like to talk about sterling euro and 50% like to talk about Euro Sterling. So I'm going to try and do this and hopefully you understand what I'm trying to do and I don't confuse myself. Again, we have the Bollinger Bands on. And the interesting thing is we can see price has for the last few months just been walking down that bottom Bollinger Band. But we are coming down to an area of support. Now, on the weekly charts I send out, for some time I've put the importance of that 82.28 area. It's an area where the market sort of should turn a bit. And we've seen that. Every time it's gone down there, it's bounced. We've had some rally. So what's 82.28 in sterling euro? It's 121.54. So every time sterling euro gets up to 120.54, those sellers come in and it's holding that line. So that's where things change. If you get a weekly close below 82.28 on euro sterling or a weekly close above 121.54, and I mean a clear one, I don't mean you close at 82.27 or 121.55. If you get a clear break, and I'll highlight that on my weekly charts and we see that, then things could be changing. So while those levels hold, I think we could be seeing maybe potential for a pullback in euro sterling. And, a pullback towards the 84.60, 85.60 area in euro sterling, and maybe a pullback in sterling euro down to 116.80, 118.20 area. So I would imagine at this stage, because it is a downtrend, quite a strong downtrend, that rallies going back up would start to struggle as they reached into that area. But again, that purple 20 moving average that I have on there, if we start to get above there, and that sort of area is the sort of 86.47, 115.65 area, then maybe something stronger is starting to happen. So we need to watch that. It's such a fluid situation at the moment. Actually, I don't like that word fluid. I don't know where I've got that from. It's one of those in words, but it's such an uncertain situation at the moment with everything happening in Ukraine that I think you really just need to watch this every day, every week, and see how these support resistance levels are working. So we're going to finish up today on the Footsie, because I've had a few people ask me about the Footsie, and I just thought, look, let's just cover it today because maybe other people are more interested in the Footsie as well. So Footsie, here we go. Last month was a bearish outside month. So like we saw in sterling dollar last year, that bearish outside month, what happens after that? You've had a higher high, lower low, lower close in an uptrend. It shows you that the sellers have taken over. You also had big spikes for the last 2 months on the top and the bottom with small bodies. And that shows you big two-way volatility. And normally when you get two-way volatility, it shows you a trend is coming to its end because the trend followers are buying it. The trend is your friend, they will say. And then the chartists will go, but the trend is your friend until you get caught at the end. And that's what's happened here. It was the end. You had those big rise in two-way volatilities of the buyers and sellers back a bit out. And after the bearish outside month, you've had a collapse down. So that has taken us down to, guess where? It's taken us to that 20 simple moving average, lovely bounce off that, and the 38.2. They both came in very close, and we've seen a bit of a rally off that area, which is understandable because look at the size of the fall down. People need to know where to take some profit. So that's going to produce some buying interest. But after a bearish outside month, rallies should struggle. As rallies go back up, they should start to struggle. And the only time you get confident that actually, look, this bearish outside month was rubbish, it was just not right, is if you get back above that bearish outside month. If you get above that body, then you can get comfortable to buy equities again. That's how charts work. That's what a chart suggests. Above that, you're going to go back higher. But at the moment, my real concern for the Footsie is the quarterly chart, because the quarterly chart is also a bearish outside quarter. Now, you don't often get bearish outside quarters. So that really worries me about the Footsie. I will cover the quarterly chart next month because I think if that quarterly chart is a bearish outside quarter, I'd look for probably potential targets of 63 and 63, 25, 60, 20, 50 area to come down, move down to sort of 6,000. But I will, as I say, I will cover that next month. But that's just what it's looking at the moment. If you close the month and the quarter below that 38.2, below that pink line, very negative. But that's it from me. Not as clever stuff as from Neil, but I appreciate we try and cover a lot of ground in the webinar in a short time. If you have questions but you don't feel happy raising them in a forum and you prefer just to discuss it, if you get in contact with your NatWest salesperson, we can always do a conference call together, or I can just answer the questions via email. So please do get in contact. Now I'll pass you back to the capable Mr. Parker.
And that's it. We've reached 11:15. Piers, thank you as always for your input.
You, Neil.
We look forward to seeing you again next month after the quarter end close. And we look forward to seeing all of you, customers on this call in April. Hopefully we've provided you with plenty of food for thought. And if you have any additional questions, please feel free to get in touch with your relationship contact. Thank you very much for dialing in, and goodbye for now.